Mike, how's it going? Good to see you.
Hey, what's up, Josh? Good to see you.
Hey, so we're going to be talking about an important subject today, bridge loans. And so I just wanted to, before we get into that, if you could introduce yourself, tell us a little bit about your background, and then we'll get into some of the questions that I have that maybe borrowers might have who are looking to sell a house and purchase a new home. So if you don't mind, just give a quick intro.
Yeah, of course. My name is Mike Points. I'm with Motif Mortgage and Pacific Trust Mortgage. I'm a loan originator. I'm a broker, and so that means I represent my clients. I don't represent a bank, so I don't have any bank that I have to do a certain amount of loans for. I represent the clients. I have a fiduciary responsibility to them, and because of that, I learned many different products that will help not only primary residential homeowners but investors as well. So today I'm going to be talking a little bit about these bridge loans from the standpoint of how they could make a lot of sense in today's market.
I think especially in today's market with contingent sellers and buyers, because especially here on the Central Coast, we've got such a limited inventory that everything that we can do to favor our clients to get them into the house that they're looking for is a plus. So I think this is an important topic. So let's just go ahead and dive into it if that's okay. So how does the bridge loan help somebody qualify and purchase a new home when other lenders, let's say, have told me, let's say I'm using an example for me, I'm a home buyer, home seller, and they've told me I can't qualify without first selling my current home, my current place of residence.
Right. So in order to enact or take advantage of a bridge loan, you must already own one piece of property. The bridge loan is essentially, you're going from property A to property B, and we're kind of bridging your financing so that you can take care of purchasing property B and then sell off property A as soon as you're ready. The reason that bridge loans allow these types of buyers, these move-up buyers or right-sizing buyers, is that we don't look at the income and credit like a typical conventional or Fannie Mae or Freddie Mac or even government loan underwriter would. And quite frankly, we don't really care that much about the income or the credit. We look at what the equity is in property A, and we look and see at property B, our new subject property, what that value is. We add those two together, and if you have enough equity to put at least 30% down, to have 30% equity between the two properties, then you don't even need to bring cash into the transaction except for your initial deposit. So to answer your question, we're a normal lender or a banker that you walk into and fill out a loan application would look at what your current income is, maybe look at your overtime, or if you're self-employed, look at the last 2 years. We just look at the assets. We look at the properties themselves. I'd be happy to give you like a for example, but I think that answers your question.
Yeah, that does. No, I really appreciate that. And I guess we could maybe answer this next question with an example, but how would somebody who is selling property A, purchasing property B, how do they make and qualify for the two mortgage payments during that process, right? Answer that question. It might be a question that some people have as far as handling that two
That's
payments.
a big question. And that's one, like I told you in the beginning of this, I'm a fiduciary, so I explain what your payments are going to be. So you'll have two mortgages. You'll have the original mortgage, if you have one, on your parting primary or the house you will eventually sell. And then you'll have a bridge loan mortgage across both of them. So a bridge loan could be as much as $1 million. I mean, it could be, usually I'm seeing in this Central Coast market, they're anywhere from $500,000 to $1 million loan, because you need to buy the whole next property basically with all of your equity. So if you have a $700,000 first property and a $1.3 million second property, those combined are $2 million. The loan that you have we'll start, there will be a payment starting the next month, interest only on the large loan amount. Okay? Obviously, you can pay for that with some of your cash reserves, income you're bringing home from your employment or other walks of life, whatever your assets provide you for income, retirement, what have you. What I like to let potential bridge loan borrowers know is that you can also roll the payment into the loan. So let's say you have two houses and you do have 30, 40, maybe 50% equity. When you combine the two together, the only loan you need is 50% of the combined value of these things. I can show you a proposal where if it's a $500,000 loan and the interest is 10%, that's a $5,000 a month payment. You can roll 2, 3, 4, 5, 6 months of that payment into the loan amount. Okay? That gives you some breathing room, and you're only going to do that because you know that as soon as you buy your replacement property, you're going to move into it, you're going to get out of the property that you're ready to sell. You're going to stage the property that you're ready to sell. You're going to make it as attractive as possible. And you're going to sell that house as quickly as you can. You're not going to take the first offer, but you're going to be more mindful of, look, I've got this big loan that I'm paying every month for, so it doesn't make sense to camp out and wait 4 or 5 months to get the best price. Let's just get a good price. Because the goal here, Josh, the only reason you would do this is to get into the house that pops up out of nowhere that you love. And you don't have to be contingent. You don't have to tell the seller, I need to sell my house to buy your house. I can sell this afterwards and move in. But I went on a little bit of a tangent. My point is, if you could stomach the payment and make the payment, I always recommend making the payment, because if you roll it into the loan, you're going to have more fees at closing, and you're going to have more interest payments because the loan's just going to be that much higher. But if you do roll it into the loan and you sell this parting primary in 2 or 3 months, and I collected 6 months of payments from you, I give the remaining payments back to you. So it's an insurance policy so that cash flow doesn't get too tight as you're enacting this somewhat aggressive strategy to finance your next house.
And I think as far as aggressive strategy, when we talk about the cost, the couple months of payment where you would be making payments on two mortgages, we had talked about this earlier about, when you are selling contingent and you have to act quickly, maybe you put in an offer on a replacement property and then you need to go get your property listed. Sometimes, and I oftentimes recommend this, is if you're selling your first property, the property you're selling, vacant, staged, you take the time with marketing. Sometimes that extra month of time where you've got such open space to allow for showings and marketing and whatnot and open houses,
Right.
That could easily make up the difference when it comes to the payments, and you get the house. Because if you've got, just think about it, if you're selling your house and you've got 4 different offers on the table, one of them is cash, maybe it's a little bit below asking, and 2
Right.
of them are loans, and the 4th one is a loan and a contingency to sell. Where do you think that contingency to sell, you're really going to have to step up strong and go over asking and remove
Yep.
some other contingencies possibly to really make your offer stand out and make up for the contingency. I'm not saying it's not it's not possible, but it certainly gets you a strong foot, putting your best foot forward, getting your offer accepted without having to necessarily go, way over asking if it's a really hot property.
Well, yeah, price is so important, but many times we're seeing in this environment where you're selling a house and buying a house, the terms that you offer the seller on the house you're buying trump the price. Price has to be in the neighborhood of the other contester or the opponent, but what if we said, I don't need an appraisal because I know that this house, they've sat with you, Josh, and this house is priced well. And so you could remove appraisal contingency. You could remove your contingency to sell another property. That is huge. And then you're above the cash person, but you're in the same ballpark as someone that maybe has a higher price than you, but has to sell their house. Well, guess what? You personally now could get countered and say, maybe they love your price, they don't even care about your terms, they just want to see how fast you can close. Because they themselves are likely going into escrow on another place, and you're the buyer that they can show that other party they have now to close, and they're not contingent, right? 72% of buyers right now have to sell a house to buy a house.
Can you
That's
say that
amazing.
again? Say that again, 72%.
70, according to the National Association of Realtors, it came out late last month. The economist for the National Association of Realtors, Yoon, I believe his last name is, Asian man, very very intelligent guy. He said 72% of the buyers right now, people that are making offers, have to sell a house to buy their house. So they don't have 250 grand in the bank. How many people do that are normal everyday Joes? It's all in the equity from the house they've owned through the pandemic burst of appreciation. They've got those low mortgages on them, and they've got to sell a house to buy their next house.
So
But yeah, I think when
let's
you think
talk.
about the payments, the cost, I just want to say this one last thing. When you think about, okay, it's about, on a $700,000 loan, it's going to be about 14, 15 grand in transaction fees. Plus, if you want to do impounds and stuff, you can do all that stuff. But the cost, the one-time costs are about 14, 15 grand. That includes the loan fees, escrow fees, what have you. 15 grand, plus if you hold a $700,000 loan for 3 months, that's $11,000 a month in interest. Okay, so that's going to be that's about 50 grand total. You're at 33 grand plus 15 grand on the transaction side. If you could go in and get that house at a fair price, not having to go over, and know that you could sell your house because you know it's in a great neighborhood, it just needs to be cleaned up a little bit, like the yard needs to be done and you need to stage it, but you could sell on the upper range of what you've been trying to get, you can make up half, if not all, of those costs in being able to sell it by showing it every day because it's vacant, you're moved out, being able to say, sure, you want to close in 11 days, or don't have to deal with tenants, or don't have to deal with, like, the dog being out back while they want to see the backyard. All those things can increase the buyer's agents coming to your house, the volume at which they come over and sell the house.
Absolutely agree. So let's talk a little bit about some concerns. So let's say you purchase property B. You moved into your new home. You got the furniture in there. It's looking great. You're having family time. You've got your previous house, previous property on the market, and maybe for whatever reason it's just not selling, or it's taking a little bit longer to sell than you anticipated. In that kind of a scenario, are there options to extend, that bridge loan? Talk me through kind of the worst case
Yeah.
scenario, or not the worst case, but just some concerns that people might have going, okay, what are my options here for taking my previous house a little longer to sell?
Yeah, so the first thing I'd like to see, so I'd stay involved with you the entire time. So I don't just sell you on the loan and move on. Like I said, I'm a fiduciary advocate for you. What I'd like to see about the 3 or 4 month mark, if you've gotten the house on the market and it's been on the market, let's say 60 days, are you actively making price reductions to try to sell the house? That's good behavior from me as the bank saying, okay, they're doing everything they can. Maybe the market, maybe rates went up. Maybe there's a serious, like, global event that's making people recluse and not buy. I have to be mindful of these things. But if you're taking action steps that show you're trying to sell the property, absolutely. We would extend the loan. We extend 3 months or 6 months all the time for physical, mental, or financial hardships. You don't just, like, lose your house. But again, it is a very serious transaction where we need to see that you're actively taking a role in selling off the other asset, because you this is a bridge. It's not a bridge to nowhere. It's a bridge to living into your new house. So, but it's not like a guillotine drops and we say, hey, we're going to go down to the courthouse. We're going to take your old house. That's not what we want to do. Now, if you weren't showing action steps and you were having hard times, then we would start talking about what the next steps were, because the balloon payment is due and maybe you need to pay a portion of it down with assets, like take money out of retirement or brokerages accounts. And again, that's not a conversation we like to have, but it's one we're willing to have if you're not serious about selling that asset.
Okay, so yeah, thank you for answering that. That is, I think, really helpful to kind of understand the process. If somebody is going to be, closing on the previous property, right? And what happens to the bridge loan when they go ahead and do that? Do they have to do a new transaction? What happens to that bridge loan?
Great question. Thank you for asking that. I don't think I touched on that well enough. So you're into your new house, your next house, let's say it's a move up, and you're selling this house, and now you've got net proceeds, just like you would if you sold your house and you didn't have another house. You're walking away with, after commissions, after paying off the bank loan, all the escrow fees. Let's say you have $400,000 in net proceeds. Exciting day, right? You take the $1 million loan that you have on this house, you take the net proceeds, as much as you want, or as much as you could qualify for. You could put all $400,000 towards this loan, make it smaller, or you could keep $100,000 back in cash, and instead of buying this loan down to $600,000, you could buy it down to $700,000. That 100 in cash could go anywhere. It's yours. We don't ask questions. But now you get what would be a refinance for a Fannie Mae or Freddie Mac loan on the final property that you're taking with you and keeping in the family. It's a 30-year mortgage, and we do market rates at that time. So there is a little bit of interest rate fluctuation risk, but when we go to set up the bridge loan in the beginning, I'm already talking about this with you. Like, here's the final step. You're going to sell this initial house for X. You're probably going to get somewhere in the vicinity of $350,000, $400,000. What are you going to do with that? If you're going to do X with that, great. You have to either pay off this loan or refinance it in 6 months. So once you sell that house, I usually use the same escrow agent as you're using in your sale transaction. So second you touch the money, you can also be doing a refinance with me and shrinking this loan down to a manageable 30-year fixed payment that you can amortize like you would any other mortgage, right? If refinance boom comes, you can refinance out of it. If you keep it forever and you pay it off, great. If you go to sell the property again in 4 or 5 years, you pay off this final loan. So that's what happens. Once the bridge is complete, there's usually a reconciliation and a final loan that you get. So it would be typically a 2-transaction deal.
Great. That answers my question. Any final comments, or how can people get a hold of you if they want to reach out and talk to you about bridge loans and whether or not it's a good fit for them?
Yeah, so the bridge loans are a product that you can use for a primary residence. I think sometimes people think bridge loans are hard money loans. They're not. I mean, they are and they aren't. We just want you to know that if you're going from a primary residence to a new primary residence, that's fine. If you were going to buy a house on the open market with private equity or hard money, you can't really buy a primary residence. You're not supposed to. So just know that a bridge loan is fine to go from a primary to primary. It's also fine to go from an investment property that you own. You can lean on that and buy your primary. And once you sell the investment property, obviously there's some capital gains exposure there, but you could take the proceeds and pay down the bridge loan for your primary residence. So you could slowly use other real estate holdings in your portfolio. One of the things I love about the bridge loan is that you could literally have no money that you have to come up with in the transaction except for the initial earnest money deposit. I think I've mentioned that in the beginning. Your 1 to 3% down payment to start escrow could be the only cash you have to put into it, and then we would give you all the financing for the rest of the property as long as the equity balance between the assets are good. And then the last thing I'll say is that we can bridge across more than one property. So I can bridge across the old primary, maybe an investment property. I bridge across commercial properties. So maybe you are a dentist and you own your dentist practice, but you don't want to put this on your old primary residence. I can bridge and take first or second position on your business property. And then when you buy the primary residence, we would find a way to pay that off. So you could go sell this property at a later date, or you could bring money into the transaction and get a refinance after you buy the house. I'm a California licensed loan officer. I'm right here on the Central Coast, but I work through, I've closed a transaction last month in San Diego. I've got a transaction going on right now near Yosemite and Coarse Gold. And I'm also getting ready to go into a new transaction just north of the Bay Area, like near San Francisco and Pacifica. So I work everywhere, but I really know the Central Coast very well. Mike Points is my name, Motif Mortgage, and you can reach me at 805-234-0903 or email me mike@motifmortgage.com. That's MOT like Tom, IF mortgage.com.
Great. Thank you, Mike. I appreciate you taking the time to sit down and explain what I think is a powerful arrow in the quiver, especially in today's market, where buyers are competing against a lot of other buyers' cash offers, etc., with limited inventory. And this, I think, gives people a great chance to get into the home that they absolutely want, and then take the time to list and sell their previous house at a later time. So thanks for taking the time and explaining this and educating me and others about the bridge loan.
You're very welcome. Thanks for having me, Josh.